Here at the Murray Group, we recognize the importance of understanding how your health plan works. We work in the health insurance world every day, but we know that most folks don't, and from the outside, it can seem like a messy, complicated process. There's a lot of truth to that, which is why we have created this video to cover some basics of health insurance. We hope this will take some of the mystery out of health insurance and answer some questions you may have been wondering about. Of course, if you have follow-up questions, you should feel free to call us at 208-765-2620 or toll-free at 877-765-2620. In this video, we will define some common terms you hear when people talk about health insurance. We will also briefly discuss the concepts behind these terms and how they may affect your choice of health plans that your employer offers. Premiums. The premium is the monthly payment you and your employer pay for your health insurance. You will see your portion of this payment on your pay stub. Your employer pays the rest, which may or may not be reflected on your pay stub. In almost every case, your portion of the payment is made pre-tax. This means your premium payment is deducted from your wages before income taxes are applied, which reduces the amount you pay in income tax. Deductible. The deductible is the amount you must pay towards medical expenses covered by your health plan during the year before your health insurance begins to chip in to help. When trying to decide between two or more plans that offer different deductibles, note that a higher deductible almost always means a lower premium. Premiums you pay for your health insurance do not count toward your deductible. After you have paid out of pocket the amount of your deductible towards covered medical expenses, you have met your deductible. Deductibles reset every time the plan renews, which is once per year. A single health plan will often have more than one deductible. For example, let's say your employer's plan offers a plan with a deductible of $2,000 for an individual and $4,000 for a family. If an employee enrolls themselves, their spouse, and 2 kids in the plan, then a $2,000 deductible will apply to each individual, meaning for any one person in the family, they must spend $2,000 out of pocket before the insurance will chip in to help pay. But once $4,000 has been spent out of pocket on covered medical expenses for the whole family, regardless of which individuals it was spent for, the family deductible is met and the insurance will chip in and help pay even if the family has not spent $2,000 out of pocket on each individual. Coinsurance. Coinsurance is the percentage of your covered medical expenses you must pay after you have met your deductible. Typically, this number is between 5% and 50%, but you should check your health plan documents to find out what your plan provides. In your health plan documents, coinsurance is often described as 2 numbers, such as 80-20. This means that the insurance covers 80% of the charge billed for covered medical services after your deductible is met, and you are responsible for the remaining 20%. For example, let's say your health plan has coinsurance of 80-20 and you have met your deductible of $2,000. For any further covered medical expenses during that plan year, you will be required to pay 20% of charges billed. So, if your provider bills $100 for a medical procedure, you will be required to pay $20, and your insurance plan will pay the remaining $80. You will be notified what portion of any medical bill is your responsibility to pay. Note that coinsurance can vary depending on whether you visit an in-network or out-of-network healthcare provider. In nearly every case, you will pay more coinsurance for services performed by out-of-network providers. Copay. A copay is the fixed dollar amount you are required to pay at the time a specific medical service is provided to you. Not all medical services provided to you will require a copay. Your health insurance plan documents will describe what services have a copay and those that don't. Copays are typical for doctor's office visits, prescriptions, and hospitalizations, but may apply in other circumstances too. Generally, copays do not count toward your deductible, and you must pay any applicable copays even if you have already met your deductible. Network. This refers to the group of healthcare providers and facilities that have agreed to accept your health plan's insurance. These providers are referred to as being in-network. This matters because going to an in-network provider will almost always cost you less in coinsurance than a provider who is not in-network, usually called an out-of-network provider. One exception to this rule is emergency medical services, which are always covered as if they are in-network, even if they are performed by an out-of-network provider. However, this does not mean that any medical services performed at the emergency room are always in-network. Non-emergency medical care received at an out-of-network emergency room will be subject to out-of-network coinsurance rates. Emergency rooms should only be used for emergency medical attention. There is one more concept we'd like to cover: VEBA Health Reimbursement Arrangement. Some plans offered to you may come with a VEBA Health Reimbursement Arrangement, or HRA. A VEBA HRA is a bank account your employer can contribute to. You may withdraw money from a VEBA HRA to pay for medical expenses that you or your spouse or dependents incur. The VEBA HRA can help you pay your deductible, copays, and other out-of-pocket medical costs, and the money in your VEBA HRA is not subject to income or other taxes as long as you use it for qualified medical expenses. If you use VEBA HRA funds to pay for non-medical expenses, you may be subject to taxes and penalties by the IRS. The money in your VEBA HRA is yours even if you switch jobs, and even if your new employer doesn't offer a VEBA HRA. And you won't have to worry if you have money left over at the end of the year in your VEBA HRA because the funds are not subject to the use it or lose it rule. VEBA HRA money rolls over from year to year and does not expire. Only your employer can contribute to the VEBA HRA, and only your employer decides how much to contribute. For tax reasons, employees are not allowed to contribute to a VEBA HRA. Second, the VEBA HRA is only available to public entity employers. One benefit to employees who are eligible for a VEBA HRA is the ability upon separation of employment, such as retirement, to roll over unused time off into the VEBA HRA tax-free. In addition, VEBA HRA funds may be invested, much like funds in a 401k retirement plan. Participants in the VEBA HRA can choose their own investment strategy, and if those funds gain value, the gains are not subject to income taxes. Now that we've covered a few of the basics, let's look at an example of how these concepts interact in a health insurance plan. Let's say Jane works for the ABC company. The ABC health insurance plan that Jade enrolled in has a $3,000 annual deductible and coinsurance of 80/20. Jane's monthly premium of $500 is deducted pre-tax from her paycheck every 2 weeks in an amount of $250, half of the monthly premium. Jane has an accident at home where she hurt her hand. Jane goes to the urgent care clinic in her neighborhood. The clinic is in-network. Jane gets an x-ray and ends up with a broken thumb, which the doctor puts in a splint and which is later put in a cast. Here is how the charges for this visit to the clinic would work out for Jane. The original charge for her visit to the clinic is $1,300. Then, $200 is taken off because of a discount that applies to charges from in-network doctors and clinics, leaving a total charge of $1,100. Charge for the visit to the clinic, $1,300. In-network discount, $200. Total charge for discount, $1,100. Jane has used her insurance a few other times this year and has already paid $2,600 out of pocket towards her deductible. That means she must pay $400 more out of pocket to meet her deductible of $3,000 before the insurance company will start helping out. After Jane's $400 out of pocket to meet her deductible, there is still $700 left on the bill from the clinic. Jane's plan has an 80/20 coinsurance, which means that the insurance company is responsible for 80% of charges after the deductible is met, and Jane is responsible for 20%. Of the remaining $700 then, the insurance company must pay 80%, or $560, and Jane must pay 20%, or $140. In the end, of the original $1,300 charge for the clinic, Jane was responsible for $540, $400 to meet her deductible, and $140 to cover her share of the coinsurance. Jane has a VEBA account that her employer has been putting money into for the last year, and she has enough in it to pay what she owes for her visit to the clinic. So Jane uses her VEBA debit card to pay the $540. Remember, since Jane has met her deductible in our example, the coinsurance will apply immediately to any further medical expenses Jane incurs through the rest of the plan year. Note, however, that Jane will still be responsible to pay her premiums and any copays that apply.